again, and welcome to the fourth webinar organized during the Rubik Hub Anniversary Edition. My name is Robert Cotuna, and I'm investment advisor within Rubik Hub team. Today, we have with us a special guest with great ecosystem experience, Gautam Kumar, who recently joined Seedblink as an investment manager, and he is also founding partner at Inbound Tech. Gautam has prepared a very useful presentation for startups interested to find out more about the venture capital investment process. We would like to be an informal meeting between friends, so I kindly invite startups, don't be shy and ask questions. Gautam, you can please share with the audience some more information about your background, maybe, and afterwards I believe that we can start the presentation. Thank you.
Okay. I will just start sharing my screen first and just start with it. So let me just full screen. So I hope everyone can see my screen, all right?
Yeah, it's fine.
Okay, I'm just going to hide it over here so everyone can see it. Start admitting people, Robert? Okay, so first of all, thank you everyone for spending your evening here listening to this intellectually stimulating webinar about the VC investment process. And I would also like to thank Robert and his team for giving me this opportunity to be here, okay? So before we begin, I just want to tell you guys what is the biggest takeaway I want you guys to have from this webinar. So I want to give you guys a framework through which you can analyze your own company from the lens of an investor. So there's going to be a lot of questions which investors ask themselves when they're evaluating your company, and probably they will ask you when you present your company to them. So this is basically the crux of this presentation, okay? So starting off, a little bit about Seedblink, but I think everyone over here is from Romania. I think everyone knows Seedblink, but in case you did not know, we are one of the fastest growing investment platforms in Europe. So far, we have backed 40 companies who have went on to raise more than 18 million funds. We also have 5 companies which were founded by women in our portfolio. And we do this because we have more than 5,000 investors from 15 countries. And recently, we also raised our 3 million Series A round to continue our vision of backing ambitious founders like you guys over here. And now I would like to say a little bit about myself, what gives me this unique perspective of talking about the VC investment process. So I have had cross-functional experience, mostly in early stage companies in Germany, France, and US. And my roles were with regards to marketing, sales, strategy, growth, those areas. So Tech Quartier was one of the Frankfurt-based companies I worked, and then Kushim was a SaaS company where I was instrumental in basically increasing their revenue by 10x in less than 6 months. So from $5,000, they went on to get 50,000. But then I transitioned into funds. So I worked for a US early stage investor, Quake Capital Partners, on their European program. So this is early stage fund, very Y Combinator-ish style. And then I worked at Multiple Capital, which is this one. And this is actually a fund that invests in VC funds. So I was analyzing the pitch decks of VC funds when they were pitching to me for investments. And then I'm also right now part of an organization called Going VC, which is basically training the next generation of VCs. They also have a fund which they are actually raising right now, and I'm advising them on that. Plus, I'm a very active mentor at WeWork Labs, Seed Ready, and there is this logo, probably everyone knows, Rubik Hub. So because of this, areas of experience in startups, on the investor side of funds, as well as on VC side, I thought it would be great that I share my knowledge with you guys so you can better pitch your company to your investors, okay? So this is basically the structure of the webinar. So we are first going to start with understanding how a VC fund is structured. And then we are going to look at some important features and terms which actually filter into the investment decision-making of these VCs. Then we are going to look at the different types of funds, how they are different, what kind of strategies they have. Then an overview of the VC investment process. Like when you are approaching them, what is exactly going on internally there. And then I want to show you something called a grading criteria. So this is also a framework which I have used when I have advised some of the people who have started angel syndicates in Germany and Switzerland. So it's quite useful to see how they are doing a grading, what questions they ask. Then we go to the crux of the matter, which is the evaluation criteria. Okay? So this is the basis of the presentation. This is going to be the framework where I'm going to look at problem, solution, timing, and exit and everything, and what questions the investors are going to ask themselves. Then we are going to top it off with some of the trends in valuation of companies in different sectors in Europe. Okay. So let's get started with the fund structure. So typically, this is how a VC fund is structured. So you have two entities. You have the LPs and the GPs. So these are the ones who are giving the money to the VC fund. So this is where like the fund is getting money from. The LPs are called limited partners, and they are usually pension funds, insurance companies, family offices, corporates, hedge funds, and so on. And they put in, let's say, 80% to 98% the size of the fund. So if I'm raising a 100 million euro fund, let's say 98 million is going to come from these limited partners. However, as the name suggests, limited, their role is quite limited. So they are not making the investment decisions in the fund. So who's making these decisions? These are actually the GPs or the general partners. So these are the people who are the VCs. These are the people who are sourcing deals, and they have to commit 2% to 20% of the fund size, right? Now, it's interesting that it's 80% to 98% for LPs because on average, LPs commit 98 to 99%. There is one famous fund called Founders Fund, which was started by Peter Thiel back in 2004, one of the founders of PayPal. And they have this ethos that we want to put our skin in the game. So that's why we as the partners will put in 20% of the fund size into the fund. And they actually have a great manifesto on it. You can go and check it out as well. Now, looking at the GPs, they are usually supported by analysts, associates, and principals. So analysts and associates are usually the ones sourcing the deals. They do not have the power to make investment decisions. Principals, on the other hand, are people who have been in the industry for, let's say, 6 to 8 years. They're basically partners in training. Depending on fund to fund, sometimes principals can have a say in whether to proceed with an investment or not. The general partners, and sometimes you will have partners and managing partners, they are the ones who will make the decision whether to go on with an investment or not. Okay. So in a nutshell, this is how a VC fund basically operates. These are the people. In recent times, we are also seeing a lot of LPs, especially super high net worth individuals. They actually want to be part of the investment process, and they actually allocate their investment of the fund into a company of that choosing because they actually want to learn how startup investment take place. Next, we are going to look at some interesting VC features and terms. So first, we are going to start with vintage. So vintage basically means when did a fund actually start its operations. So let's say I'm raising a 30 million fund right now, okay, and I need 10 million in order to start investing. I start my fundraising process. I'm going to the all different kinds of LPs. Next year, in February, I'm able to get 10 million and I start investing. But my vintage will be 2022, not 2021. So now you would wonder, okay, why this vintage is important? It's important because it ties down to the investment period. So the investment period is the number of years in which a VC fund will select all the companies which are going to be in their portfolio. So if I want to have 30 companies in my portfolio and my investment period is 3 years, okay? So 3 years after I commence my operations of investing, I'm going to make the first ticket investment in these companies. So if you are a company and you come to me in year 4, even if I like your model, even if it is aligned with the kind of investment I do, I cannot invest in you because I have already selected the companies in my portfolio. And this is the reason why early stage VC funds, they raise a new fund after every 3 to 4 years. If they are not able to do so, this means they are like, we call them like a zombie fund, okay? They talk to you, but they cannot invest. So how can you find about this? Whenever VCs these days are raising funds, it will come in the news. So please do check out when they have raised a new fund, has it been 2, 3 years or 4 years or longer before you approach them? Because then you know whether you are in the investment period or not. The fund life of a VC fund is standard 10 years, but the extension is usually denoted as 10 plus 1 plus 1. Because for each and every year of extension, the general partners need permission from the limited partners that we want to do an extension. Okay. For early stage funds, especially pre-seed and seed funds, the fund life actually extends beyond 10 years, and usually it is 12 to 16 years. A lot of the funds that started after the dot-com bubble crash, 1999-2000, and the period 2000 to 2004, and some of them are still going on because they have not been able to liquidate. Holding period is a very interesting concept which I came across when I was analyzing some funds in Germany and UK. So holding period basically means the number of years a VC fund has to hold a company in their portfolio. Okay. However, I also saw some general partners, and these are very expert kind of GPs. They will say, okay, we know everything about this industry. No, they think it's all on them, right? And they would say that we can actually estimate by looking at a company how long we will have to hold them. So this means that if the fund is in year 4 and they encounter a company and they estimate, okay, it's going to take us 8 to 9 years till this company reaches a particular, let's say, revenue, and then we can exit. And if this is not fitting with the duration of their fund life, they will just pass on the investment. Okay. And this concept is also used a lot in venture debt funds. Okay. And we are going to look at these funds, different types of funds in the next section. Investment thesis, this is basically where the VCs are telling you, okay, this is the area where we are investing. This is how much we are investing. And this is very important for you guys to know, because if you go to a fund where you are requesting, let's say your entire round size is 400,000, and you come to them and their range is 500,000 to, let's say, 1.5 million, they wouldn't be that keen to invest. Okay. Can be opportunistic, but usually you should, fall in their, basically the investment ticket range. And they will also tell you which geographies they are investing in. The next is follow-on investment, which is simple. It's basically the additional investment a fund will make in one of its portfolio companies in the later rounds. So this is all about the different features and terms that actually filter into the investment decision-making process of VCs. Now we are going to look at the different types of funds out there, mostly early stage funds. So when you want to classify funds, you can classify them, first of all, on the basis of their thesis. So they can either be a generalist or a specialist. Generalist, as the name suggests, they will invest in different sectors like fintech, agritech, healthcare, and so on. Good examples, Sequoia, Excel, Anderson Horowitz. Specialists are those who will only invest in distinct segments. For example, LVB will invest in gaming. Quantum Nation is a fund which is focused on quantum tech. Emerge Education is in education. In Germany, there is Point9, which is very much focused on B2B SaaS, although they make some other investments, but that's like their specialty. Now, taking this, we start with, let's say, angel syndicates. So angel syndicates basically means a lot of angel investors, high net worth individuals coming together, pooling in money to invest in companies. And they are usually going to invest something between 25K to 250K, although if you look at the big angel syndicates like New York Angels, Bay Area Angels, and a lot other angel groups in Western Europe as well as US, they can actually go on to invest 1 million only from the syndicate, 1 to 2 million. They usually have a generalist approach, although there are some angel communities which are starting up, which have a certain specialist approach. So they gather, let's say, corporate people who are angel investors from a specific industry. Next, we look at accelerator funds and corporate programs. So accelerators are, Y Combinator is the best example. So they will cut in small ticket sizes. They will already tell you that, hey, this is the amount of equity we need. Like example also is Entrepreneur First. They will invest $80,000 to $120,000 for, let's say, 6 to 7% of your company. So that's the standard. So they can have a generalist focus or a specialist focus, but usually they try to build a massive portfolio. So 50 to 300 companies and so on. Good examples, again, 500 startups, Y Combinator, and Quick Capital Partners, where they also had this accelerator kind of a focus. Corporate programs, on the other hand, these are not corporate venture funds. Okay, so these are basically some programs where an accelerator is going to run it, and corporations will come and say that we are looking for those companies that have a specific use case for our value chain. Okay, so it can be a telecom company looking for those kind of startups which can actually have an impact on their 5G technology, right? So this can be something with corporations. They will make an investment of 6 figures, but they're, what they are looking for is actually the knowledge part of your company. So the investment for them is a cost. It's not that they're looking for a financial gain. For VCs, it's already and always like a financial gain. So they always have, corporations have a strategic input when they are investing. Next, we look at pre-seed and seed funds. So pre-seed and seed funds, as you know, these are VC funds, usually 20 million to 100 million in size for early stage. And they would have a portfolio of 25 to 35 companies. And these days, what we are actually seeing is that there is kind of a competition happening between pre-seed and seed funds plus the accelerators, because everyone is jumping in for the same kind of deals. So for pre-seed and seed in UK, you have SeedCamp, Connect Ventures, Peregrine, Kindred, Ada. And then we look at debt funds and something called RBF, which is known as revenue-based financing. So debt funds are venture debt, meaning they are giving you a loan. It's not a convertible note, it's a loan. Usually these loans are going to be 1 million, 3 million, or 4 million, and so on. And they will target companies which are Series B+. Okay, and the interest on these loans is usually something like 10% to 16%. Okay. On the other hand, if you are an early stage company, especially if you are a SaaS company and your metrics are MRR and ARR, then revenue-based financing is an interesting way to raise some funding without giving away equity. So what they will do is they will give you revenue-based financing, which can be in the range, let's say 200,000 to 600,000, and they will set a multiple on it. So if let's say it's 300, if let's say it's 500,000, they will say we want 1.5 times this 500,000 back. Okay, so they want 750,000 back. Okay, how they are going to structure the payments? It will be structured with a fixed percentage of your monthly recurring revenue, and they will say, okay, it's going to be 10%. So if you are making 30,000, 10% of that or 3,000 is going to go there. And they will set a period which is going to be, let's say, 2 years. Typically, it's between 1.5 years and 2 years. Good thing about this approach is that if your MRR goes down, because you have a fixed percentage, you also don't have to pay them a lot. And in Germany, there is an example, Uplift One, which has started, I think, a couple of years ago, or I would say 1 year ago. So they are doing revenue-based financing. In US, it's quite a prevalent concept. There is a company called Lighthouse Capital, I think Lighter Capital, which is doing it. And for venture debt, it's Bootstrap. So overall, when you look at the early stage, these are the different types of financing, strategies which different funds, accelerators are using. Now we go to the VC investment process. So what is this process actually like? So the process actually starts with screening. So think about screening like you are basically a recruiter and you have received a lot of job applications. So similarly, VCs receive a lot of pitch decks, and they will have interns or analysts who will be doing the screening. And the objective of the screening is to basically use some basic pointers to filter out the companies. So some fund will say, okay, we don't look at any market which is less than 20 billion. So any company targeting that, it's out. Only post-revenue companies, pre-revenue is out. Stage of the business, they will say, okay, this should be at least doing 60,000 in MRR. Less than that, it's out, right? How much they are asking for in funding. If it is too less, if it is too more, it's out, okay? So once this screening is done, all the decks which are remaining, they go for something which I would say like a due diligence phase 1. So here the analyst will go more in depth, analyzing the deck, challenging the assumptions. So if you are saying we are looking at this market, this market is going at XY rate, and it's going to go that way. They will ask, okay, is it really true, right? And there is a possibility there will be a first meeting with the founders to assess that whether they would want to have an investment with this company. And important thing over here is that a lot of companies will get filtered out, And at this point, the VCs have not incurred any cost. What also happens from due diligence 1 to due diligence 2 is something called the grading, which we are going to see in the next slide. So let's say there are 10 companies VCs are interested in, but at only 3 or 4 of them will get funded, right? So how do we select them? So the VCs will do an internal grading, and I will show you what the scale looks like and how they actually do it. So then the grading will be done, and based on that, let's say some companies will get filtered out, and the ones which are remaining, they will be presented to the investment committee, where the investment committee is usually comprised of the partners or advisors of the fund. So for example, I was part of an investment committee for a fund, and we would get companies from, let's say, the Nordic regions, and then I will have a vote. So even though I'm not a general partner, my vote will actually have a strong point over there, right? So after the investment committee, 2 things can happen. One thing is the committee will say, okay, we don't want to go forward with this. Then it's a rejection. The other thing is they will say, okay, we want to move forward. And sometimes they can say, okay, we need more information on it. Okay? And if they're moving forward with it, a term sheet will be issued. So these will be the terms of the investment. Okay. And an in-depth due diligence is also being done over here. So this means the VCs will use, let's say, auditors, accountants, consultants for technical due diligence, okay, maybe background checks as well. So VCs will incur a cost in this, and they will tell you that, okay, we are going to start this process, right? And there is going to be a cost associated with it. Just to give you an example, SoftBank Vision Fund, I think everyone has heard about them. Whenever they're looking at later stage companies, they actually have a team of 20 people who are only in the risk assessment part, and they fly them around meeting all the competitors, all companies which can have synergies just in the analysis part. And this is like a very big cost which is incurred by them. So, but that's SoftBank Vision Fund. For other VCs, there's mostly legal costs associated with issuing the term sheet, right? So after this term sheet is issued, there's going to be some negotiations in cases. Well, some VCs will just say, okay, this is the term sheet, take it or leave it, right? But there's always room for negotiation where you can talk about pro rata rights, information, control rights, talk about valuation and so on. Once it is done, the investment is there, the papers are signed, and there's the approval, investment is done. Whenever in US companies are raising money through SAFE, which is Simple Agreement for Future Equity, what happens is that the investors are just going to send the paperwork. The lawyers are just going to send you the paperwork, sign it. It's usually 6 to 8 page document, and it's done. VCs will not sign something called a letter of commitment that we are actually going to invest money. Okay, that happens a bit in private equity, but not so much in VCs. So this, in a nutshell, is basically how this investment process goes on in a typical venture fund. Like the stages can be something like due diligence 1 and 2 can be, one phase as well. Now we look at the grading criteria. So this is, let's say, a grading scale, okay? So there's going to be different pointers like company purpose, timing, market size, all of this, and there will be different points. And the VCs will give some weight. And the weights will depend on the investment rationale of the VCs. Some would say, hey, we only care about the market. So we will give market not 9%, but let's say 15%. And we don't care about the team. If the market is good, the solution can scale. While some other VC would say, no, we actually care more about the product. We care more about the team. And here I have some pointers, like what are some comments with regards to the pointers when they're evaluating. So for example, a very important pointer is the month-over-month growth rate, okay, and especially for subscription models. You should be growing minimum 7%. So now you would ask, why 7%? Because if you are growing less than 7%, let's say you're growing 5%, this means your revenue will not double in 1 year. And investors want to see companies where your revenue is going to double or triple in the initial 3 years. And then it can, go on increasing at, let's say, 2x rate or 1.5x, because then again, your revenue has increased so much. So 7% is minimum, 10 to 15%, that's great. Investors are more and more interested. With regards to market, why the reliance on a big market? Because what VC investors call companies which they want to invest in as venture grade. So a lot of lifestyle companies will not actually fall into this principle of venture grade investment. So what's a venture grade investment? It's actually a company that can generate an annual revenue of, let's say, 50 million in 6 to 7 years from the time they invested. So 50 million, 50 to 75, I would say for Europe, 100 plus, that's for US. Okay. So these are some of the pointers, some important, things which I wanted to point out regarding the grading. And now we come to the crux of this presentation, which is the framework, how they are evaluated. So first, starting with the problem statement. Okay, so as an investor, I want to see how big is this problem, and is this problem real? Is there some validation? Like, is there any market research to support it? Have you conducted your own research in order to evaluate the problem? And one thing which is very interesting is this nomenclature of candy, vitamin, or painkiller. So I'll explain what it is. So candy is basically, let's say you have a problem, okay, and you are basically proposing a solution which is going to have some cool features compared to what is existing out there. But from the perspective of the user, these features you are adding are nice to have, but it doesn't mean that I'm going to stick to your product, okay, because of this. So this is like, a candy problem which you are trying to solve. It does not actually has the scope of scalability. The other is vitamin. So if you have a vitamin, this means that your solution is basically addressing 75 to, let's say, 80% of the user's needs. So if you have a vitamin, this means that you have more scope to scale. Still, it's not like the user is going to be sticking to it, but there is a scope for improvement. In Europe, I have seen a lot of companies which actually have a vitamin kind of a solution to a problem, and the investors actually invest in, right? And for top funds in US, they would be looking more for the third category, which is the painkiller. So painkiller is exactly solving the pain point. Let's go back to 2007, and Uber had just arrived. Before Uber, how was life? How was, booking a cab like? So if you can just do a simple rating of how life was before Uber and how life is after Uber, and you just grade out of 10, you will see that your experience actually improved, right? So Uber was actually addressing this painkiller problem. So this is the nomenclature with regards to candy, vitamin, and painkiller when looking at a problem statement. But after the problem, I want to see your solution. So can your solution actually scale globally? And is it better than what is available on the market? So I have seen a lot of companies in Germany where they were solving a very German problem. And they would say, yes, maybe this problem exists in France as well. But the reality was that the problem did not exist in France, because let's say they were solving something with regards to the financial area and the rules in France were different. So even though Germany is a big market, it does not mean that you can actually get way, way, way bigger because you are confined to them. Okay. So are you focusing on something which is regional? Okay. Do you have any evidence that customers will like it? So let's say you can show this kind of traction with, if you have signups coming in, if you have, let's say, users engaging, even if you don't have revenue, you're at that early stage. Some evidence like the number of followers you have, what's the engagement of the followers on your posts, and so on. If you have done some, beta testing, what is the review of the customers and so on, right? Most important part over here is, are you building a business or a product? Okay, so this is a very important question, which I, as an investor, would ask. I work with a lot of tech, let's say CEOs who have a tech background, and most of the time they would talk about how great their product is, and especially the features they want to add on their product, which is great. Okay, you want to make your product better. But I, as an investor, want to see how is this actually going to make the life of the user better, plus how is this actually going to translate into business, how it's going to get much bigger. Because if I give you the money and then you just go on working on the product, I don't see any growth happening, and you don't focus on creating a culture in your company, growing it rapidly. So then I'm a little bit worried that you are just building a product, you will go to the product side, and that's a red flag for me as an investor. Looking at the market, of course, how big is the market? Is it growing? Okay, so whenever on your pitch deck you are mentioning this is the market, segment it properly. So if, let's say, you are a cybersecurity company, the entire enterprise software market is not your market. Enterprise software market in US is like $400 billion. But if you're a cybersecurity, maybe you are actually 20 billion. But even in that 20 billion, let's say you are going to have 5-6 companies which are controlling 15 billion. And then you are actually looking at a 5 billion market to start with, but then you also have other competitors. So segment your market properly. Also talk about what is the growth rate in the market. And are you disrupting or creating a market? So there's two schools of thoughts when it comes to disrupting or creating a market. Some VC investors would say, we want those companies who are disrupting a market. Some would say, no, we are not looking for. And a good example of them is Benchmark Capital. So Benchmark Capital is one of the leading VC investors in US, and they call themselves the benchmark because of the benchmark of their returns. One of their funds actually returned 25 times, actually more than 25 times the fund size. It was a 550 million fund, and they got back like 14 billion on it. And the portfolio companies in those funds were actually WeWork, Dropbox, Airbnb, and these kind of companies. And Uber was also there. So Benchmark states that we don't look for those companies which are disrupting a market. The moment we see this, we are not going to invest. And the reason is that if you're trying to disrupt a market, how are you going to survive? Because if you're disrupting it, there is someone who is getting disrupted. So how would you react to the pressure that this disruptor can put on you? Like, how will you be able to endure as a startup this fierce competition? And we will also talk about it in one of the next pointers, like whenever you're talking with, let's say, strategic investors. The next point is the timing. So why is this the right time for the market? So you need to justify what's happening in the trends and how it is actually connected to what you are doing. And how is your go-to-market strategy credible? Now, go-to-market strategy, I've seen many founders talking about the sales or marketing strategy. Okay, they will talk about, okay, we are going to do cold emails, we are going to do more on, let's say, ads, we are going to do inbound and so on. Well, that's great, but that's your sales strategy. That's not your go-to-market. Go-to-market is basically which segments are you targeting? Okay, what is the age group, where you have a first mover advantage or where you can just go and that segment and start making your revenue. Okay, what's that strategy? So you can state something like, okay, we are a company, we are now based in Romania. Okay, we have customers over here. We will continue our base in Romania, but then we are going to expand first to, let's say, Hungary, because the market over there is similar. And then we actually go to Slovakia, then Slovenia, and later on we go to Germany. So when you make this kind of a segmentation, this is what is known as a proper go-to-market strategy. Of course, I'm giving you an example, but I'm also going to look at if you are segmenting it like that, does it actually make sense? Like you say, okay, we'll first go to Hungary. And I would question, okay, why not Estonia? So you need to be very clear about how you position your go-to-market strategy. So next is the business model. Now, in early stages, business model is not the most important metric, which as an investor, I'm going to look at, okay? Because business models can change over time. But for the time being, I want to see whether you actually have your unit economics defined. Do you actually know what's your cost of acquiring one customer, okay? And is there any network effect, which basically means if you have a lot of users coming in, what more can you do with them? What more products or services can you give to them? And are your projections credible? So don't, let's say if you are in doing something like a CRM, okay, and CRM, there are about like more than 5,000 companies which are CRMs. And if you come and say, hey, in 5 years' time, our revenue is actually going to be 20 million. The first thing I'm going to do is I'm going to look at the top 10 companies. How long did it take them to achieve, let's say, a unicorn status, and what was their revenue like? So if it took them that much time, and you're telling me 10 million, then your projections do not seem that credible, right? So basically, I'm going to challenge the assumptions of your projections. And then obviously the KPIs which you are telling me, are they indicating the health of your business? So I was evaluating a platform business where the idea was that the company needs more and more users. So the founder came to me and he says, okay, within 6 months, we actually have 1,000 users on our platform. That's great. I said, well, okay. So can you tell me how many of them are active users, daily active, how many of them are engaging and so on? And the way it turned out was that the founder had a good network and he basically invited people to sign up. Okay. But after signing up, the people would not come back. So it was like 5 to 10 people on a daily basis, and there was no level of engagement. So the KPIs, which you are basically telling your investors, right, in your pitch deck, they should indicate the health of that. And they will actually ask you the right KPIs if you have not stated them. So it's very important to know which KPIs are actually indicative of the health of your business. And it's going to vary from business model to model. Team is very important when it comes to early stages. So whenever I'm looking at the team, I want to see how self-aware are the founders. So sometimes I see founders coming and saying, yes, I can do everything. I can do sales, I can do tech and everything. Well, good for you, but it's not particularly inspiring that confidence in me as an investor. Then I also want to see that, have you actually sold the solution? Because if, let's say, you are the founders of the company and you have not sold the solution, and let's say you are saying that we are going to hire someone who will come after the fundraising, who has worked in big corporates, VP of sales, and then he or she is going to sell the solution, then this is not particularly inspiring for me as an investor, because if you yourself have not been able to sell it for the first time, how do you expect someone else to do so? They will not just come in, wave a magic wand, and boom, sales happens. Then I also want to see that, can we develop a long-term relationship? The average length of a VC fund is actually longer than the average length of a marriage in US. Okay, so I also want to see, does the team have some complementary skills? So is there someone who is in charge of marketing, has a great skill in marketing? Is there someone who is coming from sales, from tech? So is there this synergy of complementary skill set? Then I also want to see that, are you coachable? Like, if I'm giving you some advice, okay, and VCs, especially lead VCs, will take a board seat after your seed round, Series A round. So if they're giving you some advice, is it a valuable advice? Are you open to it? Or are you someone who is just focused on what is right according to you, right? And one point was the scaling. So I was working with one company, and there were 10 people in this team, right? And as a VC, I could see some structural problems in this team, okay? The coordination, the way they would be present themselves. And so it dawned on me, like, okay, with 10 people, they are like this. What happens when it is 50? What happens when it is 1,000, right? So this is also one of the structural aspects VCs will consider when they're looking at the team. And of course, does the team actually have the right credentials? So let's say you have worked as a software developer, and suddenly you come to me with an idea of, let's say, biotech company, and it's like nothing I can see which it's fitting with your credentials, and you don't even have any expert on this. So then that's a red flag for investors. Moving forward to risk, there are two facets of risks. The first facet is the VC is wanting to look at what are the risks associated with your company, like financial, legal, PR, regulatory. And then the other is that, as a VC, are they actually not taking much risk by not investing in your company? Because VC early stage investments are risky investments. So these are the two aspects which VCs have to consider. And of course, the key person risk. And this is especially with, let's say, there is a solo founder, right? So what happens if something happens to this guy, or if he leaves? That's why solo founders, whenever they go to VCs, first objection is, okay, there's just one person. Second is, does this person actually have the ability to build a team? Because that's what you have to show, that you have the ability to put together a great team, and that's a solid ingredient for your success. So when it comes to risk, these are the facets which the VCs are considering. Looking at competition, again, this is also very important, because as a VC, I want to see how the competition is going to react. Okay, many times the startups are going to use something called like a cost differentiation strategy, where you price your product low, and then and that's your go-to-market strategy, right? But what happens if your competitor, who can sustain losses, prices even lower, add some features to get in the users? How do you survive? This again boils down to the rationale of, are you disrupting or creating a market? Is there a probability that some big company, let's say Amazon, who is not active in your space, moves in? Then what happens? How do you compete with them? Okay. So I also want to see, is there any high barrier to entry? It's like anything specific advantage which you have, which any other company cannot enter. Okay. Or have you built a moat? So moat is basically a set of core competencies which are very specific to your company. No other company can actually replicate it. Okay, so do you have something to withstand the competition? With regards to funding requirements, most of the time, I've seen this with a lot of, let's say, founders in Eastern Europe, that they are not justifying the funding, okay? So if you're saying that we need 300,000, okay, euros, we need to justify how you are going to use it and what, as an investor, I'm going to get. Most of the time, founders will say, this will give us a runway of 12 months or 16 months. Well, that's good. But as an investor, I'm not giving you money just so you keep your business running. I'm basically buying the growth in your company, which means you have to tell me that this 300,000, which you are going to take to me, how much is it going to help you growth and how? So a good answer to this question is, like, whenever you are showing your funding requirements, let's say you say 300,000, put some percentages. Okay, this much will be in tech, this much will be sales, this much will be in marketing, and so on. And another point to add over there would be that the amount which you're spending on sales, how many leads will it bring you? And at the end of the day, how much more your monthly recurring revenue or your revenue is going to increase. So right now, let's say you're doing 10,000, and you will say that by putting in, let's say, 150,000, we are going to hire these people, we are going to put it in marketing, we are actually going to increase it to 50 or 60,000 at the end of 18 months, right? And that is exactly the time when we will raise our seed round, okay? Or maybe if you're a seed company, Series A round. The other question which you cannot anticipate as a founder is the funds will think about which funds will actually participate in the subsequent rounds. So mostly pre-seed and seed stage funds, they will have, let's say, some kind of relationship with the later stage, Series A, B funds. And sometimes later stage funds actually make strategic investments in seed stage funds. So Series B fund will actually give some money to a seed fund saying, okay, we actually want the access to your deal flow, right? And in doing so, basically the seed funds will know, okay, this company looks interesting for us, but let's say Excel or Sequoia will not like it, they will not fund it. So if we cannot see future, let's say, investors, follow-on investors, then it's not going to look good for us. And then there's also another red flag. Value creation, this is also with regards to what is unique about you. So how are you creating this value? Do you have any unique, expertise or patents? Okay. Have you built any reputation in the target market or community of customers? An interesting story I have is about a company called Rome Research. Okay. Rome Research, this company actually raised a seed round, at a valuation of 200 million. And everyone was baffled because there were 3 people in the company. How did they manage to raise at such a high valuation? And the reason was that before they launched the company, by the way, this company is actually a note-taking app, especially targeted towards college students, graduate students, and also for people who are into this, like writing thesis, research, and so on. So the founder actually built a community of more than 40,000 people on Twitter. Okay, and he nurtured this community before launching Rome Research. And the moment it was launched, the number of people subscribing went crazy. They had already booked like 1.6 million. This was like 1 month, within 1 month of actually launching it. So that was one of the ways how they built a community of customers beforehand, and that was how they were able to charge such a high valuation. It's quite a rare story, but you have these kind of stories. Another thing which I want to see is how many customers can you get with your price point. Okay, so if let's say you are charging right now $99.99, you are going to get a lot of customers. What happens when you make it to $99.99, right? So when you are increasing the price point, will you be able to retain them? Can you add some features, right? Because if you just come up with a strategy where you price it so low, even if you have got, let's say, 35 customers, okay, and most of your customers are paying $49.99, something like that, your monthly recurring revenue is still going to be low. You need to experiment with your price point. And another good example is a company called Algolia. It's basically putting in like the search bar for your website. In the last 8 years, Algolia has actually changed their pricing 7 times. And I think maybe they will change it again. So as an investor, I want to see how your customer base is going to grow. especially when you increase your price point. So what's going to be the churn and so on. Next is cap table. Cap table is something I find many times founders don't think about. And this is something I've got to tell you how the cap table can also affect the investment making decisions. Okay. So investors want to see how much equity you own at the time of the funding, because this is a math they are doing. And you can see over here, this is from Index Ventures. So they did this study on their portfolio companies. So if you, let's say, start a company and you are the founder and you are staying till Series D, okay, you will actually get diluted to something between 10% to 11.5%. And usually 70% of your company will be owned by all the investors, right? Now, if you look at, let's say, seed and Series A, usually when you're raising a seed round, you should be giving away 10 to 15% of your company. In Series A in US, the lead Series A investor, only the lead Series A investor would want to have something like 15% of your company. Sometimes it's even 20% of your company, right? So if, let's say, you have this kind of a cap table, right? And you are at a seed stage, and now you're approaching VCs. So if you have this, they cannot see this. They can actually see it going even down, right? And then the investors are wondering, okay, will there be enough equity left for us, right? And another aspect of the cap table is, if you have raised money through safe or convertible, have you accounted it? Safes do seem simple. The name simple is actually in their name, but when it comes to calculations, it's actually quite complicated. Even though the lawyers will do all these calculations, but as a founder, you should be aware of how much you have already given away, okay? Typically, whenever you are issuing a safe note, okay, if let's say you're raising 500,000 at a valuation cap of, let's say, 10 million, okay? So this means 500,000 divided by 10 million, that much amount of equity you have already given away, okay? Then as an investor, I also want to see who else is on the cap table and what rights do they have. And here, especially if you have corporates or family offices on the cap table, this can be a red flag for a lot of VCs. Why? A lot of the corporations, they have a strategic intent to partner with your company. Whenever they are investing, as I stated earlier, they would have a strategic mindset. So the investment for them is a cost, which also means that they would like to have more rights. They would like to keep you closer to them in the promise that, we are going to help you scale and everything, but you can deviate from your main path, which is, let's say, you are going on a path to be a $2 billion company, but the corporate actually wants to keep you on their side. So your valuation is, let's say, only going up to 70 to 80 million, so they can buy you out. So whenever you have such, corporations or family offices on the cap table, lot of the VCs, like I've seen a lot of German VCs, the moment they see a family office, they are not that interested to invest in these companies. So this is with regards to the cap table. The next is the exit. So VCs do something called an exit modeling, okay, before the investment is actually happening. So in exit modeling, they are basically testing out different scenarios, like when the exit is going to happen. And as an early stage founder, I've seen some founders talking about exits very, very openly when they're talking to investors. And I would suggest that it's not a great practice to do so, because as an investor, I can see that you are in an exit mindset. And this means that if you get an offer, even let's say the offer is quite low, you take it, and this can actually impact me. So this can happen with strategic investors. So let's say you are a company, you just raised a round with a valuation of 20 million euros, okay? And suddenly your strategic investor tells you, I would like to buy out your company at a valuation of 70 or 80 million. And you are wondering, wow, 20 million I just raised, I'm getting 80 million. Let's say you go in that route, you are rich. But as an investor, I could see your company going to a valuation of 800 million or 1 billion. I lost out on this, right? So this is the portion where the exit modeling is going to take place. I, as an investor, will want to see who can be a potential acquirer. If, let's say, you have a chat-based app with some filters, VR filters, maybe Snapchat is going to be a good acquirer for you, okay? Which metrics are going to determine the exit? And the most important takeaway from here is can the company return the fund or more than the fund? So what do I mean by this? So imagine I have a 30 million fund, okay? And I'm investing 300,000 euros in your company. And I'm anticipating that you are a good company, you will grow more, and I will have to put in 700,000 more, which means all total, I invest 1 million in your company. I also anticipate that after, let's say, I invest 700,000, I will have, let's say, 15% of your company. And from my exit modeling, I can see that at Series C or Series D, you are basically going to make an exit. Either you will go for an IPO or you will get acquired, and this is going to be a big exit valuation. So now this is what I'm wondering, that at Series C or Series D, because I'm not investing anymore in Series B and C and D onwards, the other investors will come in. So I will get diluted from 15% to, let's say, 10%. So at the time of that future exit, I will have 10% of your company, right? Now my fund size is 30 million. So I'm anticipating that can 10% of your company after 6 to 7 years, is it 30 million? Okay. If let's say it's going to be 30 million. So this means your company value has to be 100%, which is 300 million, right? So you need to achieve that valuation of 300 million. Then I do the calculation back in. Okay, if you want to be a $300 million company, how will you get value? Is it a multiple with regards to your EBITDA, which is earnings before interest, taxes, depreciation, amortization, or is it just a multiple of your annual recurring revenue, how much you're making in 1 year recurring? So if let's say it's 10 times your ARR, that's the multiple. So this means that you should be making 300 million divided by 10 or 30 million, okay, 30 million in revenue. Now I will get back into your projections and I want to see in 6 to 7 years, can you realistically attain a 30 million revenue? So you can actually have a valuation of 300 million, okay? And then I actually get back 30 million. Now, this does not mean that you tweak your financial model to actually have such high, growth numbers and assumptions. Because again, I'm also going to look at, this is my exit modeling. What have you done, right? Have you actually done something like this, or you have been more aggressive? And if you have been aggressive, how much more aggressive have you been, right? So make sure that whenever you're doing the projection, take a little bit of a bottoms-up approach whenever you're doing. So let's say if you are going to hire salespeople every 3 to 4 months, sales development representatives. So do a calculation like, okay, how many leads can they handle in 1 month? One person can handle. How many are going to get converted to customers? And then, as you are doing the additions, how it is going to look. So in that way, your projections will become more and more credible. And if you can filter it out, how the pricing will change, how you will actually introduce new products, how you will charge a premium, that will be a more better financial model, which will align with the exit modeling, which I have done. So that was all about the framework, and we are nearing the end of this webinar. So now I want to talk a little bit about the trends happening in the industry, especially in Europe. So when it comes to pre-money valuation for angel and seed level companies, it's gradually rising. It's around 3.5 million for 2020. I think it will be a bit similar or a bit more for 2021 as we are seeing, but the valuations have been rising over the past 3 to 4 years. Okay. Now, if you are a pre-seed company, you are making, let's say, 2,000 euros. You just started getting some money and so on. Don't go to a VC investor claiming a valuation of 10 million plus or 12 million plus, because this does not align with the valuations which are usually there. So if you are, let's say, a pre-seed company, especially in Eastern Europe, your valuation is going to be somewhere between 800,000 to 2 million, something like that, depending on your metrics. For seed stage company, you need to show some more growth. At least you need to be making more than 10,000 euros per month, okay? 10,000 to 20,000, so the investors get a bit interested. 40 to 50,000 to be on the safe spot, and you can charge valuations going up to 6 to 10, right? Deal sizes, typically, I would say pre-seed is usually 200,000 to 400,000. 400,000 to 800,000 in western part of Europe. And if you want to, let's say, compare all of this with Europe, so all these numbers are basically, let's say, 66.6% of that of US. So for a seed stage company, if there's average valuation in Europe is going to be, let's say, 6 million, in US it's going to be 12 million, but their KPIs are also very, very high. So seed stage companies can even have 100,000 in their monthly recurring revenue, while 100,000 in Germany is actually a Series A kind of an MRR. Looking at different sectors, the valuation of software companies is always increasing. Pharma and biotech, I would say in 2021, they are going to jump up because of the COVID, but that's just my prediction. And this is basically a way of sectoral breakdown, how it's happening. And that will be it. Thank you everyone for listening. And now we are ready for questions.
Yeah, thanks for the presentation, Gautam. I believe that were very useful information were provided throughout it. So thank you again. We have in the chat 3 questions from the audience. I will start with the first one from Mihai. How does a VC fund get rid of the companies from their portfolio after the holding period expires?
Okay, so one thing which the VC funds do is, let's say they have, after the investment period is over, they have invested in, let's say, 30 companies, right? Out of these 30 companies, in the next usually 6 to 8 months, they will know which companies are actually going to be the ones where they will put in follow-on investments, right? And this is, they will not tell you portfolio companies. They will just regard them as high performing, medium performing, low performing. So the ones which they have seen, okay, these are the low performing ones, they will already start making plans for the exit. So they will start talking in their network, secondary market, how they can actually make the exit. Sometimes they will put some pressure on the companies as well, that you need to grow and all these kind of things. But this is usually how it happens when, again, if, okay, I'll answer that question as well. But first, let me just go over here. And the other thing is that if, let's say, the companies are low performing, even at one point, the VCs will say, okay, we are actually going to back out of this, right? This is basically the milestones which were set. You have not achieved it, and we want to move forward with the other companies, right? It depends from VCs to VCs, but usually they know within, let's say, 6 to 8 months how you are growing, what kind of problems you're having, and they just want to bet on those companies where they see, okay, this is where the growth is going to come for us.
The second one would be, how much are the VC willing to negotiate the term sheet, especially the exit strategy?
Okay, so a little bit of clarification here. So negotiate in terms of the term sheet, or is it negotiation in terms, like, what do you mean by negotiation? Like the terms of ownership?
Alex, could you please tell us more information regarding your question? If you are here.
Yes, I was thinking about all the, let's say, what terms from the term sheet the VCs are not willing to negotiate regarding to, how do I say?
Okay.
The follow-up investigation, to follow up with, I don't know. My English is not on me now. Sorry.
Okay, no, it's fine. Okay, so I will try to understand I will try to answer your question. So when it comes to term sheets, it depends a lot on what is your position, especially in negotiation. Are you a phenomenal company that you can actually negotiate with the VCs? Because the VCs, they actually want to have as much of the company as possible at a lower valuation. Okay, and especially in early stages, I would say valuation, there is no clear-cut formula where you can say, okay, this is the formula we use to arrive at a valuation, right? So if, a simple way is, if you're raising 500,000 and you are giving away 10% of your company, right? So this means your valuation is 5 million. That's how you say, okay, this is 5 million. The VCs will say, oh no, it's not actually 5 million, right? We think it's actually 3 million. right? And then we put 500,000 in it, so it becomes 3.5 million. So now the negotiation for valuation will depend on this, but it also depends on how strong you are, as I said. So if mostly the terms are pretty standard. So if there is a lead investor and they will say, we want 1x liquidation preference, we want these information rights, control rights, and so on. So for the lead investor, it can be a bit daunting because then they will also put pressure on you. So it depends on what kind of relationship which you have with them. And it also depends on, as I said, your negotiation power. So does that answer your question?
Yeah, so I guess it's a case-by-case scenario, depending on the startup where it stands and also the VC.
Yes, and usually it is like a standard. So VCs will have a standard. They will say, this is it, take it or leave it. It's all about how you create a FOMO for them, fear of missing out, and how they are creating a FOMO for you, right? So it's all about how, this is done. So I think that answered your question, right?
Yeah, sure. Thank you.
Okay, so the next one.
How can you evaluate your company objectively in order to negotiate with the VC? I believe that you already answered to this question.
Yes. So that's basically the framework which I talked about. Okay, how do you evaluate your company, right? Okay. So the first thing is being a bit realistic with the valuations you are having. So I've seen some companies, 1,000 euros revenue, just started like 6 months ago, and they are coming saying 8 million is our valuation. It's not aligning, right? So some pointers I will give you. Okay, if you are in Europe, okay, you want to get the attention of VCs. 10,000 euros per month you should be making if you want to be considered for, let's say, pre-seed and seed. Okay, so 10,000 should be there. If you are making more than 20,000, okay, 20 to 40,000, then for seed you can actually go over there. If you're less than 10,000, VCs in Eastern Europe are not that interested. If you look at Western Europe, okay, so they will be interested in companies which are doing 15 to 20K, at pre-seed level, 50 to 60K, that will be seed level. 100,000, close to 6-figure in monthly recurring revenue, that is, you're coming closer to the Series A, okay? And as I told you before, that you take a valuation of a company in US, you half it, you get like Western Europe, UK as well. And then you reduce it even more, you get it for Eastern Europe, okay? So this is basically a way in which it filters down. So evaluation, like it's a very broad-ended question, okay? And it will take another webinar to answer it completely, but basically that was also point of this webinar. So I give you the framework so you can actually start analyzing your own company. And I hope these pointers helped you out.
A very interesting question from Lucian. He knows that VCs love service as a software, but what about hardware as a service? Okay.
So let's ask, what about hardware as a service? So one of the biggest criticisms I see when it comes to hardware is basically, if you have a hardware-based company, it's a very capital intensive, okay? And there are some companies, I'm looking at mostly in US, and they are raising Series A round. They don't have any revenue. They are developing deep tech or something like that. For a lot of VCs in Europe, what you also have to understand is that VC as an asset class started in US after the Second World War in 1945, right? And it proliferated into Europe later on, mostly started around in UK in the 1980s, and then, 1990s. Even in Germany, VC as an asset class actually started taking off after 2010. And the way it is practiced in Europe is much different to how it is practiced in US. And it's also because of the rationale. A lot of the people who work in finance, they actually come to work in VCs, right? But what happens is that early stage investing is a bit different compared to later stage investing, okay? And owing to this, a lot of the investors in Europe are conservative, okay? So they want to bet on those companies. Like in Germany, which are the sectors which get most funded? Number one is mobility, okay? They're crazy about mobility. Second is B2B, okay, applications. The third is B2C applications, e-commerce. If you are a deep tech company and you're going for German investors, it's going to be super hard, okay? However, if you go to the Israeli investors, right, VCs, they would be much more interested in the deep tech stuff, okay? They are willing to take much more risk. They are more specialists, right? So over here, when you have a hardware company, you have to show the traction in a way by the milestones which you have achieved. Okay, if you don't have any revenue right now, you have to showcase like how you have actually planned, executed everything, because you will require a lot of capital and you have to show that you have followed a line. Okay, that will give me a bit more confidence. So there are some funds which will actually invest in hardware companies. I have seen one company which is a very, very capital intensive one, and they actually got someone to like a fund to invest in them because this person was actually bored for that fund, right? And that person actually joined. So using networking, and it's always, VC, it's basically management of relationships, and you need to network as much as possible. You need to go out there, talk to people who can make warm introductions for you. But at the same time, you need to keep, let's say, your projections credible, everything credible. But for hardware, I wouldn't say, okay, there's another question. I would say if you want to show your traction, you have to show the team you have put together, what is the expertise, how much you have achieved as tractions. There are some VCs, in Germany as well, who will focus a bit on hardware. You will have to find them. Okay. And, it's not that difficult to find them. And then you need to think about an approach strategy. So direct cold calling, it's not going to work out. Try to use, let's say, apps like Clubhouse, Lunch Club. VCs are very much active on Lunch Club as well. Or find someone who can make an introduction from LinkedIn, right? So these can be some ways in which you do so, but make sure that you at least have a very strong storyline to support like why your hardware company is actually going to scale up, right? But I think over the next 2 to 3 years, a lot of the investors will bet on hardware companies as well. But then again, that's just my thought.
Excellent. Thank you very much.
Okay, welcome. What is next?
How do single founders show that he can create a team? From Cătălin.
Okay, so if you are a single founder, first of all, it depends on like which stage you are. If you are just starting out, ideation stage, this is not the time to approach a VC. Okay, you should always approach a VC when you have at least something concrete to say. Like your company is at least incorporated, you have an MVP out there, you have done some testing and so on, right? And when it comes to, let's say, building a team, you can actually emphasize on your past experiences. So let's say you worked in a corporation where you actually built up a team or you led a team, right? So now as an investor, I can see, okay, yes, you are starting out right now. Okay, you started on your own. You have achieved a lot on your own. You have previous experience working and building teams, right? Because when I'm also analyzing companies, I go very deep. I don't know about other investors, but I go very deep into the backgrounds, right? There's a reference check and everything. I'm going to talk to people we have worked before. And then again, it's not like a basic, I will also ask a lot of trick questions. So whenever I, as a VC, interview founders, I also have some trick questions, which I use to actually see whether they are actually aligned to their company or, what kind of mindsets they have. Some VCs have these kind of trick questions as well. So emphasize on your experience set, emphasize on, or you can show other ways in which you have built a team. If let's say you have been part of some community, okay, you built up a community or something, because we want to see leadership, right? That you would be able to do so. So that will be it.
We have another question from Nicu Muntean.
Okay, the specifics in evaluating startups in Romania, some particular have a big problem. In most cases, we need to launch our products first here locally. Many reasons for this. Okay. So when it comes to small markets, okay, it is not necessary that you need to show an MRR of $10,000. It's not necessary. If you can do so, then it's great. Okay, but if you don't have that, you at least need to show some other kind of metrics. Okay, let's say you have built a team. Okay, you have some people on board. So I can see, okay, you're serious. Even if it's a small market, how much traction, how much word of mouth have you achieved, how much has been the development of your company. So for example, the strategy used by a lot of Israeli companies. Israel, it's a good big country, but it's not that big of a country compared to other economies, right? But whenever I look at Israeli companies, what I see is that they would have a product launched in their home country, right? And they would say, okay, we got this much amount of traction, but that's not our focus. We actually want to go to US. We have already done our Delaware C Corp, and that is where our market is. Similarly, if you start off in Romania, you always need to show like a bigger focus, right? So right now we are starting, we have done some validation, initial testing, even if your revenue is low, okay? If you can show that your users are liking the product, such evidences, that will bolster a lot of confidence in the investors, okay? Compared to thinking about, okay, I need to get to that, 20,000 or 30,000. So initially, as much, using different ways, if you can show the traction. Okay, which is the next one.
Questions from Pushkar.
Okay, how do VCs value early stage startups? Do they help with sales, introducing them to potential clients? Okay, so the question of valuation. Valuation, there are different methods to do valuation. So the first one, the most simple one, is an implied method. Okay, implied method is basically the founder saying, I'm raising 500,000, 10%, 5 million. Okay, that's where the negotiation will begin. In some cases, there are some methods like the VC method, the Burkus method, where they will put some, qualitative factors, and for each and every factor, they will put in 200K as valuation, right? So early stages, valuation is not something which is put in like a formula, right? So valuation will also depend on what is the target ownership a VC is wanting to have in your company. So if you want to say, I want to give you 10% over here, maybe they will say, okay, we actually are valuing your company low. They will not tell you why, but the reason is actually they want 15% of your company, because they know that later on they will put more money, okay, and then they don't put money and then they get diluted, right? So this is with regards to how, the valuation goes on. So it's negotiation, right? Whenever founders come to me, it's a matter of negotiation, right? How do you negotiate and how do you actually set it? So if you are saying you have a valuation of, let's say 5 million, right? And this is because of how much money you're raising, how much equity you're giving out. Now I look at your KPIs, okay? How much money you are actually making. If you are making, let's say 2,000 euros, your month-over-month growth rate is 4%, I will say, no, you're not a company which is worth 5 million, because I've seen other companies which have a much better month-over-month growth rate. Then you have to specify, okay, there is something else which we have, which, the other companies don't have. Let's say we are going to launch this new product, or we actually are working on doing something which is going to increase the value. And then this is how the negotiation is actually going to be shaped. And there's another question. Do they help with sales, introducing them to potential clients? Okay, so VCs have, there are different types of VCs. So a lot of them will say, yes, we do add value, right? We are going to add value. Okay, everyone will say that. That's why please accept money from us, right? But there are, one will be, I will say, like simple VCs. So simple VCs, think of them like, that's like 𝐸𝐴𝐶, those kind of them. And they would be something like, okay, we add value. And then you will have operator VCs, okay? Good example is Project A Ventures in Germany. So they have an operational team. They're going to help out with tech, marketing, sales, and everything, right? So if, let's say, you are talking to a VC and they say, okay, we are going to help you out, it's important for you to ask, can you give me some examples of how you have helped out other companies? So for example, the companies I work with, okay? Personally, if I'm working with a seed stage company right now, I'm going to help them throughout their Series A. So after they work with me, seed round is raised, I'm going to, sit with them, okay, set out the KPIs, use my operational experience. If I can make an introductions, of course, that's what I'm going to do, right? And other VCs, maybe they can do it. Some VCs have done it. They add a lot of value to their companies, while some VCs also say that we invest in those companies which can actually actually don't need us, right? So,
do VCs see a large cap table as a positive or a negative point?
Okay, what is a large cap table meaning?
Good question. I believe that you already answered to that question.
Yeah,
Sure.
large cap table, I think it means that 10 plus investors. Okay, 10 plus investors. Okay, so you already have a lot of investors. So now this means that your cap table is crowded. Okay, so VCs usually, they do not like a very crowded cap table. Again, they also want to know who is doing what and when are they going to make an exit. In some cases, if your company is good, you have a lot of people, the VCs would want to know, okay, how about like how many of them want to exit, right? Because whenever you have angel investors, like Series A, Series B, sometimes they're going to make the exit because they are individual people. They don't have an investment horizon like a VC, 10 years. They just want something 4 to 5 years and they go out. So again, I also want to see what rights do they have? Can they actually hamper any processes which I have, especially ROFR, which is right of first refusal. So do they have ROFR over there? So this means that, let's say there's going to be an acquisition. I like it, they say no, and it doesn't happen, right? But usually it is understandable sometimes that you're going to have a lot of people on your cap table. I've seen some companies from Central Eastern Europe. It was not easy for them to raise money, right? So they had to go this way. And then they actually came as a venture grade investment. And the VCs were actually able to understand, okay, this is something which can be mitigated. And I think there's also another
question from Cătălin. When a VC is interested in the automotive industry, well, I believe that depends on the investment thesis, but you can answer to the question.
Exactly. That depends on the investment thesis. There are a lot of these funds in Germany. Automotive mobility, that's a big sector out there. That's like one of the lifeblood of the German economy as well. So one fund, I think, Assembly Ventures, even though they are, I think, seed or Series A kind, Assembly Ventures, they are focused a bit on this mobility focus. They also have some connections in Texas, I believe. So there are funds in Germany you can find, also in UK, who are interested in automotive as well. But it depends on their expertise as well and their thesis. Yeah.
I know that we are already running out of time, but I have also 2 questions for you, Gautam.
Absolutely.
The first one would be, you mentioned at some point regarding the term sheet and some aspects with term sheet. My question would be, what is your opinion about the option pool? Because I know that many of the investors are very happy to see that a startup has the option pool. And I was wondering, what is your opinion about that?
Well, option pools are very important because as a startup, it's also a war on talent. So how are you going to attract and retain talent? And as a startup, even if you have raised money, you cannot, let's say in many cases, give a salary which is higher than what's offered in the market, right? What's offered in the corporations. So you have to incentivize them. So typically, there should be a vesting plan. Like in US, we are looking at companies, even the founders should have a vesting plan when they're starting out, right? So that's point number 1. When it comes to options, point number 2 is, especially in seed stages, usually it's mostly done internally. So they don't have much hires, but after, let's say, raising the seed round, the option pool can be, let's say, 10%. Series A, yes, at this point, the investors will say, have it at least like 15%. And then Series B, it can be like the total option pool available can be 20, but then it should be like that, 20%. And then at most, in some cases, it can be 25%, but should be fluctuating between 15 to 25. 20% is a good one, right? So option pool, definitely, it's very, very important, because if you say, hey, we are not going to issue any options to our employees. So I also want to see, okay, how are you going to, retain them? So does that answer your question?
Yes, thank you. I have another question, and after that we can take the last one from the audience. What are the most important recommendation, I would say, that you have for the startups before starting having discussion with investors? I have in mind to have a good pitch deck, to be legally compliant, or other things. What do you believe are the most important things that they should have before starting discussion?
So first of all, you have to understand, are you actually ready for a VC investment, right? Because when you are going for a VC investment, as I said, there are different criteria. They have certain exit expectations, right? So are you at that stage where you can basically show that vision to investors? Typically, when you are super early pre-seed stage, it's difficult. You can go to pre-seed funds. So pre-seed funds are smaller funds. Their exit expectations is not going to be that big. Micro funds and all, they can be even 10 million funds, 15 million funds, and they're going to invest small ticket sizes like 20,000, 50,000, especially around Eastern Europe, right? So pitch deck is very important, and especially how you are basically telling the story. Always remember that whenever you are sending your pitch deck to an investor, it should be structured in a way where a person just reading it can understand. Because the pitch deck which you use when you are presenting it, right, it's different from the pitch deck which you will send, because you can use some pictures, you can use different tone, you can use some nonverbal gestures to do so, right? And especially it should be in a format where the VCs actually understand, because they're screening a lot of decks, right? So I would be screening at some days something like 100 decks in a day. Now I'm filtering like 2 companies, 100 decks. I just look at it, and then I just try to understand, okay, first of all, title slide. What is this company about? Do I understand what are they doing? I'll go, okay, 4 or 5 slides. And then if still I don't get it, like what you guys are actually doing, I would be a bit like, okay, like they are not able to tell their stories correctly, right? So the storytelling, so start with a slide, your title slide name, and have a tagline, okay? So have something like Uber for, let's say, freight carriers, right? So I know, okay, it's something related to freight. Then you start with the problem, okay? How big is the problem? Okay, so then I get an idea. So let's say freight, the freight business is very fragmented. There is no price transparency over here. So I know, okay, you're going to propose something which is going to solve this problem, right? But if you start off with some story and I have no idea, like what are you doing, right? So this is with regards to pitch deck, okay? Make it in a way like problem, solution, then your market, your business side, your business model, your traction, fundraising ask, okay? The objective of the pitch deck is not to get an investment from a VC, but it's actually to get the attention of the VC. So you can talk to them more about it, right? So this will be with regards to pitch deck. Also, another important point is prepare something which is called like a due diligence docket, okay? It's like a document set. So certificate of incorporation, anything legal and compliant, all these documents, it should be ready with you, okay? And especially when you are approaching angel investors. You show them the pitch deck and everything, and they will say, okay, we want to know more. And you can say, okay, we can show you, let's say, this document set, you get everything over here, right? So in that way, you are already prepared when the investor asks for it. Because if they're asking for it, they usually don't have that much time, right? So if they see, and they are a well-known VC fund, right? So then they would be like, okay, this is taking some time, we move on to the next one, right? So these will be some initial tips from me. And we have, I think,
the last 2 questions from Pushkar, who is very active. Are VCs looking for a specific runway for the funds being raised, or are they more focused on milestone achievements?
Okay, I think he had another question. VCs looking for specific runway for being raised. Okay, so runway, usually it's going to boil down also on your next round of funding. If I'm a seed stage investor, for me, what is success? Success is when I can write a LinkedIn post stating our portfolio company has raised a Series A round, right? That's a success for me. Because when that happens, I can go back to my limited partners and I can tell them, hey, this is what I'm doing. Give me more money for my fund, right? So I can start a second fund. That's success. Now, that boils down to the fact that when are you going to be able to raise Series A round, okay? So right now you have a certain, let's say certain revenue. So after, let's say 18 months, which is the runway which you are expecting from the money I give you, where are you going to be? Are you going to be at that metric? Are you going to miss it? Or, we'll have to give you a bridge round, right? So based on that, I'm going to estimate, okay, what is, going to be the future for this company, right? And Milestones and achievements. Yes. So milestones are set, they are reviewed. Most of the time board meetings are done quarterly, like in US we do we do quarterly. Sometimes in some companies, based on the articles of association, it can be done semi-annually as well. So when it comes to milestones, as I stated, the moment you get the money from them, they are monitoring you for the next 6 to 8 months. Okay, how are you actually achieving them? Another thing is that sometimes what investors will do is you approach them right now, they are interested. I will always ask them, okay, what are you currently working on about your company, especially your current task? Just tell me about some meeting, you are meeting someone or so on, right? As general as possible. And you can say, yes, we are working on this and that. We are going to release this feature, that feature, and so on. And next week, let's say we meet again and I ask you, hey, what happened? Did you release that feature? What happened over there? And so on. So during this initial phases, if as a VC, I see, yeah, you're missing deadlines. Maybe the so-called great developer you have was not so great, actually. So these are also certain things which they test out. Okay, and the milestones which are going to be set, there's going to be a lot of things happening, right? Pandemic basically pushed a lot of businesses back, right? So investors in 2020, they were like, okay, we are only going to support those companies which are performing the best. Okay, so during the pandemic in Europe, the fundraisings which actually happened to later stage big round companies. So even if the money was a lot, it was actually on those kind of companies, right? So I think he had another question.
Yes.
So also to answer the part, yes, they are focused a bit on milestone achievements. If you're not achieving your milestones, again, this also means that you are going to be on that low performing stage, right? So they would be like, okay, we are not going to support this company that much because as investors, our time is also limited. Okay. And the final question is, anti-dilution clauses common at the pre-seed stage? Actually, yes. Okay, again, depends on investor to investor, but pre-seed means super, super risky, right? So at this point, investors will want to have some anti-dilution. Okay, so liquidation preferences, standard is usually 1x, non-participating right now. But if let's say some investor you have and they are actually asking for 2x, 3x, 4x, this means two things as well. The first thing is that maybe they don't have that much faith in you. And the second is you need to also ask the question that, is this the right investor for me? Because if they are asking for such a high liquidation preference, they already are thinking that maybe this is not going to go over, going to get big, right? So with regards to liquidation preference, this will happen. But also keep in mind, the liquidation preferences which you set in your, let's say, first round, and then you go to the second round investor will want to have the same liquidation preferences. And this is also the case with safe instruments. So if a safe investment, you raise 500,000 valuation cap of 10 million, and then you go with someone else 750,000, and then they want to actually have, let's say, a bigger valuation cap or smaller valuation cap, right? So they will actually start that. Plus, if you raise money through safe, there is a valuation cap in your seed round. Your Series A valuation discussions will start from that cap. Like if you say, hey, our valuation cap was actually 15 million. Now we are raising at 25 million. The investor would first start, okay, let's first talk about 10 million. Why your company is valued right now at 25 million. Let's look at the metrics. Then the negotiation will actually start from that 10 million. I hope that answered the question. Anyone else has any other question, needs more clarification on my answers?
If not, I believe that we can end this webinar. Yeah, thanks for the answers. Gautam, on behalf of Rubik Hub team and also startup community, thank you very much for all the provided information. For the audience, thanks for joining the event. I hope you received insights tonight, very useful, and see you next time. Have a great night, everybody.
I will just put in my LinkedIn if anyone wants to connect. Okay. So
you can leave also your email address if you agree with that, Gautam.
Absolutely. So I'll just put it here. So this is my LinkedIn and